One of the things I've been warning about on this channel for a year now is that the electric vehicle industry is going to face a lot of challenges as they increase production, and they likely increase production beyond where demand is. We're going to see prices fall. We're going to see companies not reach profitability in the way that they thought they would. And I think we're starting to see plenty of signs that that is already happening. Tesla is obviously the biggest game in town, and we know that their margins have been declining for the past year. That is likely to continue as they increase production, or their balance is going to be they stop increasing production to keep margins high, and then growth isn't going to be what investors are expecting. As we move down the curve into companies who aren't as big as Tesla, we have General Motors and Ford pulling back on their EV production plans. There's questions about Lucid's abilities to survive, and even Rivian, who I think had probably the best products and chance to make it in the EV market, is going to face a lot of headwinds as they grow their production pretty significantly over the next few years. So I want to go through a few trends today, some data points that have come out recently that are at least worth thinking about, whether you're bullish or bearish on the EV space. These companies have been valued much more like growth stocks and like tech stocks than their counterparts in the auto segment. And I don't see a lot of reason that that's going to be the case. And they're going to run into the same challenges that the auto industry has run into over and over again. These aren't new challenges for the auto industry. They may just be new to electric vehicle investors. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. Check out fool.com/ASYM for their top 10 stocks to buy right now. The first thing I want to go over is just overall sales trends, because the auto industry is going to be something that EV companies are going to have to deal with overall. And if sales are declining for every type of vehicle and they're declining for EVs, that's pretty telling about where market share is going. So I'll start with some of that data. This is data from the St. Louis Federal Reserve. And this goes back to during the pandemic when auto production was down really significantly. You can see that this is an annualized pace and a seasonally adjusted annualized pace. So this is 12.7 million sales is what were taking place on an annualized basis in September 2021. That rose pretty steadily through June of this year, 16.6 million units at that point. Long term, the average is around 17 million units in the US, but you can see that that pace has declined pretty sharply over the last few months. Just under 16 million units for the month of October. Now, the backdrop here is really what's important. Interest rates have been rising for over a year now, but it's not going to be an immediate impact, the increase in interest rates. So you're going to have some people who have been looking for a car for months can now finally get one. They're going to just accept a higher rate than they maybe anticipated previously. Maybe you have a little bit of downward pressure on sales, but you're still going to move vehicles at that higher rate. But eventually you get to the point where you get to the marginal customer, the customer who can go either way, who can say, well, I can afford this for a payment, but I can't afford that. And for this vehicle, that higher rate just pushes me over the edge, so I'm not going to make that purchase. This is something that every auto company has talked about on their conference calls. Elon Musk spent a lot of time talking about it in very basic terms, that when interest rates go up, people just simply can't buy vehicles, can't afford vehicles. And so we're starting to see that. And this is the broad economic data. Let's go to some specific electric vehicle data. This is from Argonne National Lab. And the column that I want to focus on is the left one here, battery electric vehicles. And this goes all the way back to 2010. So you can see not selling a lot of vehicles then. But when we go down to October 2023, you can see the trends over the last year, up year over year. Shouldn't surprise anybody. But look at what has happened since April. So October sales are lower than any month since April. The outlier here is the end of quarter, and it's typically Tesla who is pushing a bunch of sales at the end of the quarter. So that's why you see the outlier here in June and September. So not really surprising that numbers are down a little bit in October, but this is down sharply more than it was both of the last two quarters. Now, it isn't like overall sales are doing a whole lot better, but the electric vehicle market is not the outlier here. We aren't seeing electric vehicles sell like crazy and ICE vehicles sit on lots. We're seeing both struggle right now. So it tells you that the dynamics in the industry are really the same no matter what kind of company you're looking at. These trends are important because all of these electric vehicle companies are expecting to increase their production and need to sell vehicles at high prices and high margins. I'm going to go through three companies here that I think are going to be the most interesting to watch over the next year. I'm going to start with Rivian. And this is Rivian's operating cash flow and net operating profit after tax. You can see that the company is losing just a tremendous amount of money. What they need to do is both ramp their existing Normal, Illinois facility and then build out a second facility in Georgia, which will make its R2 line. And that's where we could potentially see Rivian become profitable. But at that point, we're talking about another couple 100,000 vehicles hitting the roads. And this is going to only increase competition among the existing automakers. Another one to look at that I think is really in trouble is Lucid, trying to sell vehicles that are $100,000 or more in most cases, losing a couple of $1 billion per year. These are trailing 12-month numbers. We can see that operating cash number, negative $2.7 billion, just a crazy amount of money to lose on an annual basis when you're only selling a few thousand cars. I mean, this is not a company that's selling a lot of vehicles. Fisker is facing their own cash challenges. You can see that operating cash flow and net operating profit after tax is negative for them as well. I'm also going to show this from their quarterly report. This is what I thought was an interesting comment from Fisker in their most recent quarterly report. It says that they had cash on hand of $527.4 million as of September 30th. They had burned approximately $1.5 billion in the most recent year after not generating any significant revenue, but did not think that they were going to have a problem being a going concern. And basically what they said is that they're expecting to be able to continue to raise capital. And that's going to be the business model for them, is just continue to sell stock, issue senior convertible notes, which they did in July and September. So I have questions about whether they're even going to be able to survive given the backdrop of both demand and margins and pricing for electric vehicles. I think there's a ton of questions outstanding for that company. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. Add all this together and you get a really difficult operating environment for electric vehicle companies. Everybody is crowding into the space. There's only so much demand for electric vehicles from customers. We're seeing now that traditional vehicles, ICE vehicles as we call them, are more available on dealer lots. They're actually selling relatively well. GM and Ford's numbers are pretty positive from the ICE side, and they're not seeing a lot of demand from the electric vehicle side. That's partially because of who they are as companies, but we're not exactly seeing these EV specific companies outside of Tesla selling like hotcakes. They're not making a lot of vehicles. Lucid is having trouble making the vehicles that it's selling. And even Tesla, who is really the crown jewel in the EV space right now, is having to lower prices and induce customers with leases, with referral bonuses, with all kinds of things that automakers have been using for decades to try to move product off the lot. At the same time, inventory is building for Tesla over the past year. So lots of warning signs are here. And I think a lot of these upstart companies that had high hopes for the EV future are going to have a really hard time getting there. We've seen these stock values fall over the past year. And I think that's going to continue for all these companies that are not profitable, that cannot stand on their own. Tesla's a little bit different story. That's a company, I have more questions about their valuation. And do you want to pay a multiple that's well over 10x what you would pay for a traditional automaker? I've discussed that in other videos. But for companies like Fisker, Rivian, and Lucid, we need to ask questions about, can they survive? Can they get to the point where they're mass producing vehicles, selling at a reasonable margin, and have positive free cash flow coming from the business? Because that is not happening in the foreseeable future for any of those three companies. And the capital markets are just not interested in funding companies that are going to lose money for the foreseeable future. So something for investors to think about, especially if we continue to get squeezed on how much consumers are willing to spend on new vehicles driven by higher interest rates. But let me know what you think about the state of the EV market. Leave those comments in the comments section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.